Hello everybody, welcome to this weekend's silver analysis. It is the week ending February the 10th. This will be a two-part video. Let's get on with the first part. And this is the weekly candle. This video will mostly be gold and silver, but pretty much mostly silver. And this first part will be entirely that of silver. And I have the weekly chart, and I have it set within the stages that market has traded within. And there's three ways of moving: up, sideways, or lower. So that's the way this is set up. As the bullish trend started in 2003 from around $4.50 per ounce, the market was in an uptrend, which moved sideways. But overall, you could say, well, it kind of had a very short down move, and then it went higher, and then it went lower, and that's also true as well. So you can really make a judgment case sometimes if it's neutral or if there's a few different trends. I'm just going to make this neutral as a sideways range. And then the duration of 45 weeks going bullish. You go bullish, sideways, bullish, sideways, bullish, bullish, sideways, bullish, and bearish. That's how the stories went. And the 35 weeks on the current level is an if. Markets tops and bottoms are known well after the fact. Therefore, if this 2610 or 2614 level is the bottom, then the duration of time from this April high to this low would be that of 35 weeks. If, of course, it breaks down below this level, we'll get more into that later on within the next two videos, this one and the next one, then the duration of time will be greater than that of 35 weeks. But it's only so long you can stay in a trend type deal. So that would also state that if we do break below here down to like 20 or 23, 22 area, that it'd probably be pretty fast. We'll go more over that later on. So let's move on to a line chart that has a trend line that connected. Well, it was mainly this level, this trend line here, because that was the essence of trend for the August of 2010 to April of 2011 rally. So let's bring that up right now. And that's our trend line. And currently, it's at $140 per ounce. So it's got a long ways to go. And, well, quite frankly, there's only one way to retest that level. Mathematically guaranteed only one way, and that's to have at least one or a series of trend lines that has a greater rate of ascent than this one in here. So something like this or this has a greater rate, but something like that is a lower rate. And well, after it fell from this mark in here down to this bottom in here, at that point it needed to have a greater rate of ascent, and the rate from the bottom was something in the nature of, well, this here, which of course, as you can see, is a greater rate. Within this video, we're going to talk a lot about 33.58, well, really 33.5, because that is a substantially significant level, as we can see amongst here. But before we do that, let's take a look at the first time $33.58 was tested. Now, I'm using that exact number because it's one of the two key Fibonacci levels within that area. And whether you want to pick 33, 34, it's really in that area pretty much for the most part. And when it first came up to this level, it was roughly around Christmas Eve. This data comes from the LBMA webpage. So I get one closing value per day, whereas today I get the intraday highs and lows. But for the time frame that we had, we can see that it did stabilize amongst this level for quite some time. Really, it was about 2.5 months that it did stabilize within this level. And then, boom, it's just got hammered. And when you see a market fall from 33, after it already fell about 30% already from this high, and then now it falls an additional, what was 33, about 65%, which more, of course, was coming. And that's a pretty massive volatile move. And the move overall was from 50 down to like 3.5. That's over 90% of a retracement, which, quite frankly, is massive. So let's take a look at 33.5 as we currently could see it today. And this is a line chart. Now, this has a swing line, high and low, which means that whatever the intraday highs and lows, that's what's used within this chart. And I can look. I've talked about this before. It's very substantial how this number has played out, and it's back to this level right again now as we were back in here. What's important is if it's going to sell off, that it finds this higher low. And I can't stress how important that it's going to be or what the else factor is going to be. Because oftentimes if you make a pattern where you do something like this and you're looking to decide, well, what's the direction of this trend looking like? In a situation as I've drawn this in here now, that's an extremely bullish looking setup because of the fact that you are testing a significant level after establishing a higher low. Whereas, if something were to occur where it either just doesn't find any support or even little support and then does something like this, then this market is probably going to be in trouble for another wave lower. Now, we've already had the 30 weeks or so within this bear run, which is why I think if we do break below this level, the most likely scenario is that it's going to crash down fairly hard, something we've seen before already, and then bounce back fairly fast. That would be the most likely scenario that would happen on a breakdown below that level. Now what we'll do is we'll match up these lows within this high, and then we'll do the exact same shape box, or the exact same distance from top to bottom, and then do something like this. Yeah, pretty much. So we can see that it's pretty much two different ranges. The first range has 33.58 as support and about 43.5 to 44 as resistance. And this one is, well, the lines aren't drawn properly. It should be 43.5 because I've done this already when you calculate it within this low. And I'll just do it this way just to make it easy. Yeah, something like this. So 43.5. And so what's interesting is there's a possibility that if it does break below this level here, that we have the same movement that we had in here. And the movement was from 50 down to 43.5, so that's about 6.5, but that's about 12% or so, 12-13%. So a reduction of 12-13% from this level on 26 would be roughly about 22.50, 23-ish or so as a possible price target. You also got that complete larger level at 18, 20, 22, and that's if, of course, that happens, because that could be very well just jumping the gun. But here's the deal. If this level gives in to the upside, then this possibility is that it could either establish it fairly fast or keep the stable pattern of higher highs and higher lows going back to this level is very efficient. And going to this level, this means that on a bullish level, you can go all the way back down here and then still, again, possibly be bullish if it goes all the way up to 42, back down to 33.5, and back up to 42. That would be a bullish pattern, because if you can go from point A to point B without much of a correction, then as long as you correct more than a 61.8% retracement, then things are still going fine, basically. And we'll now finish off this first part within a chart I haven't done in quite some time, which is a direction from the 50-day low and 50-day high. In fact, this chart is over 10,000 periods going back to the time frame of July 2010. So it's going back a decent amount of time. The way that's calculated is it automatically, the computer that is, automatically finds the lowest point over the last 50 days, the highest point over the last 50 days, and from that point it can determine its direction from the 50-day low or high. So if the low is set at $26.10 or 15 cents, I can't remember offhand what it is, but assuming that you're at 30 and the low is 26, that means you're 4 above 26, and that would work out to about 15-16%. Now, as far as the high is concerned, if say you're at, say the high is 40 of a chart and you're at 20, then you would be at 100% on this chart. Not 50%, but 100%. And the reason why is that is it takes the difference from high to low, which would be 20, and it divides it by the low, which is, of course, 20, which is why it would be 100%. But in a more normal basis, if, say, you got a high of 40, and you're trading in at 35 right now, then if you do 5 divided by 35, you should get about 14%. And I'm using that methodology to match on a, I guess you can say, a fair level, or so that the numbers can match percentage-wise evenly for up and down moves. Therefore, when the movements are pretty high like we see in here on either chart, that means you're coming a long ways from the highs or lows. And when it's this one in chart, you've come a long ways from the lows, or you've come a long ways from the high. Therefore, the last few rallies that we've received has got us 25, maybe 30% above the lowest period. And that's not like it was in here where it's found stabilization at the 30%, where within this chart, former levels of bullish support are now being used as bullish levels of resistance, aka not as strong. Another way to look at this is when this does end up breaking above this level and really gets above 43%, that this thing can really have the legs to get going. Now, the bearish side from these periods here, you pretty much have two matching points, although playing it a little bit differently. The first one got above 30% and stabilized for quite some time, just like it did here. The second one had a huge gain, and then this one crashed lower. This one, obviously, this type of movement shows that it was a bull market. At least it was starting at the end of December of last year. And right now we can see that the market on the downside, or we're basically that whatever line is in front of the other line, that's who's in control of the market. So clear-cut control from this point to this point, the bulls were in clear control. This is going from August of 2010 to January of 2011. And then the market sold off for a little while. We see the markets go from 31 to 26 back then, and that's what caused this. It looked like the sellers were going to regain control, but nope, because it was just a quick little period. We can see in here that from this point to here, the buyers were in control. So when we've seen it go to 50 and then crash it down, that's when the sellers regained control. In the summer of last year, the buyers tried to regain control and did for a little while, but obviously once the September smackdown came in, that changed everything. And then from the point of the September smackdown to right in here, or really just about a month or so ago, we have managed to see that the buyers right now have gained control of the market, but the market control is nowhere near parabolic, and that is, of course, when we go above this level, well, then maybe we will. Thank you for watching the first part, and the second part will have the 18 period averages and those normal charts with gold and silver. Take care.